Hi, and welcome to Ones and Tooze, FP's economics podcast. Every week we take a couple data points, use them to try to explain the world. I'm Cameron Abadi, FP's deputy editor, with you in Washington this week. As always, Adam Tooze, FP's economics columnist and Columbia University professor, is with us in New York. Hi, Adam.
Hi, Cam.
So, we actually have one data point for you all this week that is tied to the financial market turmoil that swept the world in recent days. We didn't really have trouble selecting that as a topic for obvious reasons. But first, we wanted to share a bit of good news. I've mentioned in recent weeks that we're doing a live show in Washington, D.C. on Tuesday, September 17th. We can now say that we're adding a second show in New York City on Wednesday, September 25th. The tickets for both shows are available for purchase. In Washington, they've been on sale for a couple weeks, so if you're interested, you might want to act quick. In New York, the venue is the Caveat in Manhattan, which is slightly smaller than the DC venue, 6th and I. If you're interested in those tickets, you might want to get them soon, too. We sold out the last time we did a show there, so yeah, these shows are fun. We try to make them site-specific. Of course, always love meeting our listeners, so check it out. You can find in-person tickets, but also virtual tickets if you're not near either of these cities, and also VIP tickets for DC specifically at 6thandI.org for Washington, or for the New York tickets, caveat.nyc. The links to those venues and the tickets are also in our show notes. Check it out. We'd love to see you there. The data point I was mentioning, that is 114,000, which is the number of jobs that the United States added in the month of July. That was below expectations, which were supposed to be around 150,000 jobs added. That disappointing number resulted in all kinds of financial market turmoil.
Traders may want to put on their hard hats. That's because US markets picked up where Japan left off, and the global stock market intensifies as the sell-off continues. There are two things.
114,000 jobs created last month, according to the BLS. That is significantly lower than the numbers John was just giving you for what was anticipated.
There's a bit of an overreaction here. 114 is still a really strong number. I think we were used to these outsized numbers when we were recovering from the pandemic, where we know millions of people were let go, and then you had to recover them. So this is probably about
the Dow Jones Industrial Average fell more than 1,000 points on the Monday after that jobs report. The NASDAQ and S&P markets also dropped more than 3%. These are some of the biggest drops in years in the stock market. And especially in Japan, the Nikkei index had its worst day since 1987, dropping 12.4%. This is pretty universal. European markets also struggled, all because of this jobs number in the United States and the suggestion that the United States could be entering a recession. And so we wanted to figure out what exactly is going on there. Adam, I imagine you can help. The first question that came to mind for me, Adam, is what role the Federal Reserve has played in all of this. The Federal Reserve quite concertedly did not lower interest rates in the weeks before this jobs number and the resulting turmoil. And I'm curious whether we could simply conclude that the Fed messed up here. I mean, do you think that Jerome Powell, the head of the Fed, foresaw this risk? I mean, did he have a sense of the signs of a potential U.S. recession and this kind of resulting market response? Or do you think he was taken by surprise here? I mean, was basically all of this turmoil priced into his policy decision on interest rates or not? How does the Fed look at this?
I think we need to be fair to the Fed here. I think everyone was taken by surprise by the scale of this shock. I mean, to use a sort of weather forecasting analogy, I think this is a little bit like blaming ourselves for getting drenched at a barbecue because we got hit by like a sudden summer thunderstorm and everyone got drenched. I feel it's that kind of an event. The Fed took the decision to hold rates and to postpone the interest rate cut because it was, broadly speaking, confident about the state of the US economy. And I think that was really the read last week, which was that we bought into the soft landing scenario. That's what the Fed was taking to heart too, that the economy was landing soft, but it was landing fast. The US economy is in reasonably strong health. So you don't cut rates now because you don't need to, because the economy doesn't need the support, but you'll make the cut in the fall. But that entire thesis of the soft landing hinges in the view of the markets, which is the crucial variable here, because what we're trying to explain is this huge sort of market tantrum. It hinges on a strong labor market. So you have to believe that there's a strong labor market sustaining household income and therefore sustaining consumption. And that general slowdown tendency is also being offset by the huge strength in tech. And there'd been jitters about tech for a while, but the labor market was still, broadly speaking, in a positive mood. And it's then those weak labor market numbers that, if you like, break the envelope of complacency that's sitting around the market. And then a bunch of technical factors kick in. Quant funds, so-called, that chase trends in the market, all basically found themselves on the wrong side of what were then evolving developments. So they'd been moving into stocks, even if they appeared quite highly valued. They'd been betting against rich country bonds because those are a safe haven asset. So if you're going onto the equity side, you short them. And they'd been betting on a weak Japanese currency as a source of funding. And all of those developments suddenly pitted the other way. And that's what then produced this really dramatic unwind. And we're talking about tens, if not hundreds of billions of dollars of assets that need to be reallocated, where somebody has been, short bonds, short the yen, very heavily in equities, and suddenly needs to shift that rebalancing. And individual trading groups, individual groups of hedge funds and other managers, asset managers who've been playing a particular strategy, can need to do hundreds of billions of dollars worth of reallocation. Now, should the Fed have anticipated all of this? Did the Fed anticipate all of this? No, it clearly didn't. And neither did the markets, because if the markets had anticipated this, they would have moved in a different way. And arguably, I don't think the Fed should be in the business, and it's not healthy for the markets to believe that the Fed does anticipate this kind of thing, right? The Fed has a dual mandate, which is price stability and maximum employment. And if and only if the market turmoil impacts those two variables, should the Fed react in any kind of way. There was quite a lot of talk in the middle of the panic that the Fed might do an early rate cut to somehow stabilize. I think that's, from the point of view of the broader political economy, the least healthy thing the Fed could do, because that would feed the instinct of high-risk investors that they basically have what's called the Fed put, in other words, protection against downside from the Fed. I think the much sounder policy is really for the Fed to take a distance view of this, keep its cool, see if anything substantial develops, but on the whole, really keep all of this technically driven market development at arm's length.
Yeah, I did see a quote from Austin Goolsbee, the head of the Chicago branch of the Fed, basically saying, it's not the Fed's job to worry about stock market losses, which suggests that, some of this turmoil is sort of, I guess, irrelevant to the Fed, at least in its core function. But I did want to turn to Japan, because it was at the center of this kind of drama. And basic question, which is, how does Japan figure into all this? I mean, there was a talk of specifically the carry trade being involved in these dramatic events. What does that even mean, Adam? Can you explain that?
So carry is when you make profit by literally carrying something from one place to another. So in this case, what you're carrying is yen. You borrow Japanese yen. Why? Because interest rates are low, and that makes them cheap. And because Japanese interest rates are relatively low and have been for a long time relative to rising US interest rates, that depresses the Japanese currency. So not only do you pay less to borrow in yen, but when you repay, you're more likely than not to be repaying on cheaper terms in dollar terms. And so what you do then with those is you invest that borrowed credit in something that yields a higher return in the United States. How big was this flow? It's very hard to quantify, but low trillions of dollars in terms of positioning, I think, would not be far off the mark. That sounds gigantic, but Other financial markets churn multiples of that every single day. So the repo market on US Treasuries, $2 to $3 trillion a day. Global foreign exchange market, $7 trillion a day. So we're talking about a large, substantial, but not overwhelmingly gigantic flow. And the theory is that a big part of the disruption of recent days, which looks large but not gigantic and overwhelming, might have something to do with the unwinding of this trade. And if you look at it, you kind of think, why is this even bad news? Because basically this trade, this carry trade, is a bet on Japanese depression. What you're betting is that the Japanese economy will stay in such a low, depressed, languishing state that the Bank of Japan will have to keep interest rates low relative to the US economy, which is going gangbusters. So why would this unwind? It would unwind because of good news in Japan. It unwinds because the Japanese economy, in fact, has begun to accelerate and beat the prolonged deflation that it's in. That then causes the Bank of Japan to raise interest rates, thinking it can do that because the economy is relatively resilient and international money has been flowing the other way as well, not just yen credits out, but substantial amounts of longer-term investment into the Japanese stock market. All of this makes the Bank of Japan feel better about the world, indeed even begin to worry about inflation, which at that point means it needs to, for the first time in years, not decades, actually raise interest rates above zero. That squeezes the margin of difference between the yen interest rate and the American interest rate on which the entire carry trade is premised. That also, of course, changes the momentum in the foreign exchange market. It makes the yen more attractive relative to the dollar, and so the depreciation tendency is replaced by an appreciation tendency, and all of a sudden the entire carry trade begins to look really worrying. And that then unleashes this relaxation of tension, if you like, or the unwinding of positions. And as it happens, the shock is that the people who are short yen, they've borrowed yen, exchanged them for dollars, and are now investing the dollars. When they repay, they need the yen. They want to repay now because the terms of the carry trade aren't there anymore. They suddenly need yen. The shock is the yen appreciates. And from the point of view of actual Japanese businesses trying to export to the United States and the rest of the world, an appreciating yen is really bad news. So the Japanese stock exchange sells off at the same time as the money flows back into Japan and the yen appreciates, improves in value against the dollar. Now, that's the Japanese story in a nutshell, I think. It's a sudden unwinding, globally leveraged and amplified by the positioning of big global and Japanese investors in which their assumptions have been shifted. Does this have much impact on the United States? At the margin, perhaps, not just on the United States. So one of the things people did with the carry trade was borrow yen and buy Mexican peso. So the peso weakened very dramatically over the course of these last couple of days. So there's been ripple effects. People even saw the ripple effects in the Eurozone peripheral market. So you borrow yen and you invest in a relatively high yielding Italian or Spanish Eurozone bond. All of those trades unwound. But they don't explain the scale of the movement in the United States that we saw earlier this week. There, I think we need to go to a slightly more meta explanation, which is very interesting and very important, which is that the premise of the yen carry trade is the same as the premise of a very large number of other relatively speculative bets that have been put on the equity markets in particular in the United States in the last 18 months or so, which is, the technical term for it is a low volatility environment, an environment in which you don't expect very large swings of any of the key parameters in the economy. And that then positions you to nudge towards various types of risk, like borrowing yen to invest in peso, or borrowing yen to invest in the United States, or engaging in some complicated derivative where you bet effectively that the movement of individual stocks will be larger than the movement of the overall pile of stocks, which has been a so-called dispersion trade, which has been popular in the US. All of these trades are premised on us thinking we know, or investors thinking they know, the basic state of the world. And the yen carry trade unraveling is just indicative of John Authors at Bloomberg had like this panel of 7 or 8 popular trades of recent months and the last 18 months or so, all of which you can imagine having hundreds of billions of dollars piled on them. All of them, broadly speaking, unraveling at this moment. And that's what creates this whiplash effect, where people who are basically mispositioned in a market where there's more volatility, or there's even something called vol of vol. So basically you position yourself for a low volatility environment. You can also position yourself for an environment in which volatility itself doesn't change very much. And what we've seen is a very large surge in the second derivative of volatility. So the change in the rate of change. And that has shocked a lot of these derivative positions. That's, I think, the way of thinking about the best way of thinking about the carry trades positioning. It's part of a broader picture of the unraveling of a certain image of where the United States economy and its financial markets were going.
We're going to take a quick break here now, but we will be back in a second to continue talking about the financial market turmoil this past week. I do wonder what specific role tech stocks have played in all of this. You know, specifically tech stocks seem to have dropped amid this turmoil, and after rising for so long and sort of being at the center of America's economic story in recent years. And yeah, I'm curious, are tech companies overvalued in the stock market? And how would we even know whether this sector is overvalued in the first place?
Well, valuation is always going to be about relativities, right? That's the only way we can really do it. And so the answer is a series of ratios. And you can see this, I think, operating in the mind of, America's most famous and in some ways most successful investor, Warren Buffett. So Buffett apparently has a rule. Well, he has many rules, apparently. But one rule that is quite famous is the Warren Buffett stock price rule. And that is a ratio that compares the overall valuation of the US equity market to American GDP. So it's a ratio of what Americans' income flow is and the valuation of the American stock market. And that currently is at a ratio that is close to 2, and that's very high. In other words, US GDP is about 28 trillion, and the American stock market's about 56 trillion in terms of valuation. And that tells you that stocks in general are overvalued relative to GDP, according to historical trends. So then you say to yourself, like Buffett did and Berkshire Hathaway did, is like, we want less stocks. So what they did was they moved out of long equities into cash. They have about $277 billion worth of cash sitting around. But how do you do this? Well, what have you got to do? You've got to sell assets. And famously, what Berkshire Hathaway announced over the weekend between the first drama of last week and this week is that they had sold half their Apple portfolio. Why would you sell Apple? Well, because if you want to, because they've run up and so you've got profits to take. But if you're trying to reduce your portfolio, nowadays, if you're going to sell your portfolio, it's going to be these big stocks. 37% of the value of the S&P 500 is right now made out of 10 stocks. And the Magnificent Seven, the Apple, Amazon, Alphabet, Meta, Microsoft, NVIDIA, and Tesla, make up 31% of the index. So deciding that you are going to pull back from stocks altogether, you end up by default pulling back from tech. Is tech in particular especially overvalued? Well, then that comes down to another ratio. So we've had the Buffett ratio of equities to GDP. We've had the share of the big stocks in the equities. Now the question is, are these equities, their stock prices, overvalued relative to what? Well, the basic ratio that you'd use is the so-called PE ratio, the price to earnings ratio. And that is the amount of dollars you would spend to buy a dollar of a company's revenue. And if you're optimistic about a company, you obviously will tend to pay more for the chance to get a dollar of its revenue. And a value investor, somebody who is looking in over the long run, not just following trends and following memes and whatever, would generally speaking look for a ratio of about 20 to 1. So you pay $20 to get $1 of earnings. You could think of it almost as like a 5% return in terms of income on your $20 investment, right? Of course, you also hope to get return from the appreciation of the underlying assets. But think of it, that's why 20 comes out as a ratio. Anything less than that is probably undervalued. Numbers above that are scary high valuations. The dot-com bubble, which was the kind of epic period of massive tech overvaluation, produced ratios of 60 to 1. So where are we now? Well, if you look at the Alphabets, the Microsofts, the Metas of this world, they're all actually around the 30 mark, 30 to 40. So Google is at about 30 to 1, Microsoft's at about 33. So these are expensive, but they're not massively expensive shares by comparison. If you want .com bubble levels of valuation, you have to go to Nvidia, which is peaking at 60, or Tesla, which is peaking at 58, I think, something like that, price to earnings ratio. So this would be the exercise that you'd go through. And then there's two different ways of looking at that. One is that the prices are too low, and so you ought to bid them up even more. Or you could say what it tells you is the earnings of these companies are just super resilient. They have good business models. These are not fancy, glorified online pet food dealers, the most notorious instances of the .com bubble. These are world-bestriding tech titans whose business models will literally define how we live for the rest of our lives. And so paying 30 to 1, 34 to 1, even 40 to 1 is not something that's sort of a crazy kind of bid. And then you ask, well, why is this? And you come to another ratio, which is their earnings. How are they generating those earnings? Are they having to work like crazy, or do they have decent margins? And again, if we look at the .com bubble, the margins on the tech businesses were small. They were down in the low teens. And the margins on tech businesses today, as it were, how much profit they take out of any given volume of business, are well over 20%, which means that they have pricing power and they have market power. So you put all of that together and you conclude, as I think as most people do, that as elevated as these valuations are, with the exceptions of the Nvidias and the Teslas, which are really steep in price by these ratio measures, companies like Microsoft, the leader in AI, or Google, the dominant search engine that were outside the, in the western side of the Great Firewall, they would not appear on the face of it to be massively overvalued. By this kind of ratio analysis, there may be other stories out there which blow all this kind of confidence up, but this is why, generally speaking, people were not expecting some giant unwind.
Interesting. Yeah. You mentioned there how Warren Buffett was turning to holding cash. And yeah, that was something also I noticed. Seems like a turn towards wanting to hold the US dollar as a kind of stable investment at a broader time of turmoil. And that got me wondering about the general role of the US dollar and its value. And there seemed something paradoxical to me about that. It's in a catch-22 sort of way, in a heads we win, tails we lose sense. Namely, that when, the U.S. economy is strong, it seems like the dollar becomes strong too, in the way, I guess, dynamic you are also kind of referring to in Japan maybe, but when the economy weakens in the ways that we've been describing in the U.S. with potential recession, stock market drops, everyone wants dollars then too. So then the dollar stays strong or even gains maybe potentially in value. And, I'm just curious about that, whether that's really as, paradoxical as I'm making it out to seem. And then if not, like, what are the circumstances under which then the dollar does weaken?
So this is a really interesting, really fascinating and really tricky topic to talk about. And it all hinges on what we mean by strength. And just to avoid confusing our really attentive listeners, the Japan story is a story of the dollar reversing. In other words, the dollar was strong against the yen, or perhaps more reasonably, we would say the yen was weak against the dollar. And then, because of the relative shift in interest rates, the yen actually suddenly appreciated against the dollar. In other words, against the yen, the dollar depreciated at that moment. And that's what caused the shock to the carry trade, right, which was premised on dollar strength versus yen weakness. So moments like that happen all the time. The dollar is by no means fixed in value or eternally fated to increase against other currencies. Not at all. That's one point to make. First of all, the current moment is one in which an assumption of dollar strength was reversed, which flipped a bunch of trading strategies, particularly on the pair with the yen, right? So just so that we're all on the same page. It is, however, also true, as you say, that there is a fear and optimism-driven logic that says that when the American economy is doing well, the dollar strengthens because people want to buy into American financial markets so as to get a slice of the earnings, right? So the American stock exchange booms, people move into the dollar so as to buy. They put down the P for the E in the ratio that we were talking about a minute ago. And this is the kicker, when things are bad and the world economy is stressed, people also want to buy dollars, not to buy American equity, but to buy the safe haven reserve asset of the world, which is US Treasuries, American government debt. And so the dollar strengthens in bad situations too. And it is also true. So this is a kind of, if you like, strength in the sense of resilience, little bit like a trampoline is strong, right? You go down, you know you're going to come back up again. There's a kind of resilience effect. It's also true, and this is another way in which people talk about dollar strength, dollar dominance, dollar power, is that reserve assets are, generally speaking, held either in dollars or in, if you look at where the shifts are happening, in other currencies really closely related to the dollar. And they're closely related because their central banks have very close relations with the Fed. And so in extremis, they could get dollars by way of what's called a currency swap. And so the fact that people are shuffling out of US dollar reserves into euros or Australian dollars or Canadian dollars or Swiss franc always seems to me a little bit of an illusion, because you're basically just moving your money around within the Federal Reserve superintended dollar-backed global financial system, right? So that's another definition of dollar strength. All of these things are true, right, and about the world. But if you ask about dollar strength in the most conventional sense, in other words, where does it stand relative to peer currencies in value over time, the answer is much more ambiguous. If you take especially the longest dollar index that we've got, which is relative to the other members of the G7, so the rich economies of the world, Europe, Japan, Canada, part of that index. If you look at a very long series all the way back to the early 1970s, the moment when the gold-backed dollar system ended and we moved into floating exchange rates, where it's meaningful, therefore, to talk about currency movements, the fiat money era. Over that period, there's really no trend at all in the value of the dollar. Or, to put it more precisely, there is a downward trend in the value of the dollar from the early 70s until 2008, and then that reverses. The downward trend, and I'm just eyeballing this, not doing econometrics, is to the tune of about 20%, and the reversal has been to the tune of about 20%. So we live in a period of dollar strengthening in the order of 20%, which means that according to this index, the dollar's position right now is exactly to what it was in the early 1970s. So at that level, you can't speak about strength, as it were, the dollar soaring against the euro or the yen is not the long-run historical norm. And these things are all interrelated to each other, because if you are the reserve currency of the world, the last thing in the world that anyone needs is for that reserve currency to be particularly scarce, especially tightening. This is the utter fallacy built into the Bitcoin idea, right? That the best kind of money is the scarce kind that automatically gets scarcer over time. It's such a silly idea of what money is. Now, money does have a store of value function, but for a reserve currency, that's only one of its functions. If, as the dollar has over the last 50 years, it broadly tracks in long oceanic swings the movements of all other advanced economy currencies, that's perfectly fine for going along with. It can fluctuate up and down in ways which allow people to make money and then lose money as well, as we've seen. But the crucial thing is it's amply abundant. And the reason why the US dollar has not appreciated in price terms whilst having this preeminent position is that America's political economy, that is its fiscal policy, its monetary policy, and the actions of its private balance sheets, take ample advantage of America's dominant position. They exploit exorbitant privilege. We exploit exorbitant privilege to basically produce lots of dollars. So as in demand as it is, as much as everyone in the world wants to hold it for reserve purposes, still wants to hold it and do businesses in it, you can count on the American credit system and its policymakers to liberally provide it. And that, in a sense, is what keeps it in this equilibrium. So it's strong, not in the naive sense of being more expensive, right? Or always at a certain value. It's strong in the sense that it's where you come back to, always. You can't really go anywhere else. And in the sense that it's always there for you. It's that kind of image of strength. It's like, I've got you. There's going to be dollar credit. This is what the Fed has said again and again and again to global markets. Don't matter. I don't care what pickle you're in. We're not going to ask too much about moral hazard. We understand the system has to keep on going. And so at crucial moments, the dollar will be there. That's, I think, the way to think about its strength.
Yeah, got it. Okay. That's interesting. Yeah. Strong in the sense of a kind of rock, or a kind of like, it almost sounds like
I went with a paternal thing there.
Yeah,
like,
there's
it's
a
like a big
metaphor
warm
there.
embrace.
Definitely. I was
the
going to
cuddly
say,
Fed,
yeah.
that will Bernanke, Yellen, and Powell embody this of like, seriously concerned about what's going on in the global dollar system and ready to do all sorts of rather weird things if necessary to keep the wheels on the bus. That's the way in which it's really fundamentally so. And this, of course, by contrast, the Bank of Japan has been this freaky monster doing all these Godzilla monetary policy, and the Europeans are like the Wicked Witch a lot of the time, right? The ECB has been precisely not that kind of guardian of the euro. There's all these questions about whether in an emergency it would actually be there. And there's nothing more fundamental to establishing a reserve currency management system than that. Confidence, liquidity, abundance of relatively cheap credit at the key moments.
So finally, I guess I wanted to sort of return to where this conversation started, just a little while ago. We were talking about whether the Fed saw this coming. And yeah, this has kind of stuck with me. And I wonder whether there's a kind of broader question of whether we ever really know what's going on in the economy at any given time. I mean, there's a sort of epistemological aspect to economic analysis I wanted to ask about. Because, I mean, again, a few weeks ago, the vibes, to use that word that's very much in currency and in social media, I mean, everything seemed uniformly positive about the U.S. economy, including the way we discussed it on this podcast. And, on one hand, I wonder, should we portray that as overlooking weaknesses? Or is there really something else going on about how, these markets work? And in the sense, like, if markets are either optimistic or pessimistic at any given time, is that necessarily always going to obscure data that's available in the economy, but like we just don't have access to it precisely because of the prevailing vibes at any given time? Like, is there a kind of level in which knowledge about economic conditions are always necessarily obscured because of the way that markets work and the kind of emotion that always kind of is informing how markets work?
I think I love this direction of travel here, but I think I would invert it and simply say, in a more positive vein, that all knowledge about the economy is constructed. It's part of a narrative. It's made up. That's the only way we know. I think the way you pose the question to me implies that you would imagine that if we could just strip the emotion away, there would be some truth underneath that we could see. That I don't think is plausible. A, it's not a plausible epistemological model in general, and B, about something like the economy, which is a social system full of people who are sentient and have emotions and narratives about the world. That's the object that we're studying. So this is much more like crowd psychology or group storytelling or a giant game of multi-directional Chinese whispers in which we're all whispering stories to each other and they get passed on, right? That's the nature of economic activity, which is, to me, as a humanist, at heart, at some level, why it's so fascinating, right? It comes along in the form of sort of a social systemic quantifiable physics problem, and in fact, it's not. It's a giant social drama. But in that giant social drama, there are things we can say for sure. For instance, which is, and the most fundamental one, is that the markets are not the economy. Right? The markets are a particularly highly leveraged, highly incentivized, extreme gossip circle in which people are making bets on the rest of reality. Right? That's literally what they are. You sit and watch Bloomberg every morning. They, in a very self-conscious way, reflect on this. Everyone there is telling a story. And the entire conversation, once you back away from thinking of it as technical analysis, is really about very technically supercharged storytelling. And they're very frank about it. And I find that extremely illuminating. And there is a disconnect, an absolute fundamental disconnect between, and this is not just a matter of fake narrative versus reality, but also what it is the narratives in the markets are driving. So the narratives in the markets are driving hugely leveraged bets, but however are indirect bets on events in the world. So it is simultaneously true that all that happened in the last week is that Goldman Sachs raised its expectation of an actual bona fide on the ground Main Street recession, actual people losing actual jobs because people driven by narrative made choices that caused them to lose jobs. It raised its probability from 15% to 25%. That's Goldman's best bet. And who are we to second guess them? That's what happened, right? So that's an increase, but from a relatively modest probability to a slightly less modest probability. It is also true that if billions of, if not trillions of dollars of investments were hedged on the bookmaker's bet that it was a 15% probability, and now you're told it's 25, in a very real way, that causes you to need to reposition. And that market crash may in due course further inch up the probability of somebody actually experiencing a recession, say from 25 to 27%, because Goldman may not have allowed for the unearthly shakeout that's going to happen in the markets as a result of it changing its prediction. This is the reflexivity, right? But if you step back from all of this and say, where are we and where is the US economy? The Goldman numbers seem to me, broadly speaking, right. It's been true for months that many different indicators in the US economy have begun to indicate a slightly higher risk of a slightly harder landing. The SARM rule triggered, which is the idea that if unemployment increases by 0.5 percentage point, it's likely to go on increasing because the unemployment rate's like a yo-yo. It's never stable. So if it's gone down, it's likely to bounce back up. If it starts going up, it's likely to increase speed for a while. And that's what happened last week, is this SARM rule triggered. But Claudia Sahm is modest and very smart economist. And she said, there are a whole bunch of circumstances which make this a very peculiar situation. It's not people actually losing jobs. And this morning, as we're recording, this is the Thursday of this week, the unemployment number came in, which was really optimistic. In other words, the newly unemployed people, slightly more than 200,000 people became newly unemployed in the US. People were expecting a higher number. The pessimists were. That has adjusted our expectation a little bit towards the positive side. Maybe we're inching back down now from a 27% probability of a recession on Monday in the middle of the turmoil back down to an 18% probability. I'm just making these numbers up, but this is the kind of adjustment that is actually going on in the real economy, about which we're getting data, real data from real markets all the time. Not just markets, but industrial processes, production numbers, raw materials, prices, and so on. And then at the same time, they're reflected in this echo chamber of highly incentivized storytellers in the financial markets. And all the time, the relationship between the two pieces shifts. But what happened is the probability of a slightly harder landing increased marginally, and then may have been further increased by the shock wave that it released in financial markets. But the good news this morning is the labor market numbers were slightly better, and that makes that probability slightly on the shift it back towards an optimistic direction. How bad could this get in the absolute worst case? If you follow the logic of the SARM rule, if unemployment rises by 0.5 percentage point, what you then expect is that to build momentum and head towards something that's more truly a recession. Her rule says that on average, unemployment rises by if it rises by 0.5 percentage point on average, it stops rising when it's risen by 2 percentage points. So that would take us from 4% unemployment to 6% unemployment, which would be terrible for hundreds of thousands, if not millions of Americans, but it would hardly spell a cataclysmic recession. Right? It would be a severe slowdown with an uptick in unemployment, but that's the kind of number that we're talking about. People shouldn't stitch together a scenario in which the huge sell-off on Monday culminates in a banking crisis and the Great Depression. Right? That is not the world. It's this weird inching around probabilities. It's like bookmakers on bookmakers on bookmakers on bookmakers, and then we watch the horses actually run, and what we're seeing is relative repositioning of the horses, and everyone in the stands is trying to reposition their bets as we go along. And huge amounts of money, of course, can be made and lost on that repositioning, which has a real effect in its own right. It's not illusion versus reality here, or narrative versus actual fact. It's this weird mixture of both all the time.
No, this is a useful sort of, I guess, a kind of transcendental critique of kind of economic knowledge. I guess there's no non-narrative economic knowledge, but yeah, the weird thing, as you say, is it's all cloaked in data. It's all cloaked in rules. This is kind of terminology that sounds objective, but I guess is always necessarily caught up in these stories. Yeah, we will have to end the conversation here for now. We will be back as always, next week. Ones and Tooze is written and edited by me, Cameron Abadi, along with Adam Tooze. It's produced by Claudia Tatey, Laura Rossbrow-Tellem, Rob Sachs, and Dan Efron. This show is made possible through the support of foreign policy readers. If you're interested in news and analysis from around the world, consider subscribing. Listeners to Ones and Tooze even get a 15% discount. Just go to foreignpolicy.com/subscribe and use the promo code TOOZE at checkout. That's TOOZE. And listeners, as always, we love getting your feedback. You can leave voice messages on the Ones and Tooze homepage on foreignpolicy.com, or email us, podcast@foreignpolicy.com, or you can tweet us. That's @OnesandTwozePod. Thanks very much for listening, and we'll be back in your feed next week.